Welcome back. Well, let's get talking about a couple of more frontline numbers. UPL reported Q2 earnings yesterday. It was a big beat on margins aided by higher gross margins. Management has also reiterated their FY23 guidance for revenue and EBITDA growth of 12 to 15 and 15 to 18% respectively. Our colleague Sonal Bhutra got in touch with the global CEO Shroff and Mike Frank, the CEO of Global Corp Protection business at UPL, to get a fine print of the quarter gone by. And she began by asking him why the volumes declined in the second quarter. Listen in.
Generally, the team has been focusing on improved realization and improved profitability. And with the erratic, weather patterns, we have been focusing on making sure that we are not overstocking the channel. With the decline in some of the raw material costs we are seeing, we see that we are still going to deliver good numbers, and we are going to continue to grow the business. But this is a period where we are just tightening, and with the interest rate curves increasing, we are focusing on tightening the credit in the business and just focusing on cash. Therefore, we are just managing the business much more tightly.
Okay. Take your point. Mr. Frank, let me come across to you on this one. Strong margin expansion, and this is in a time when we are talking that inflation was still high in Q2. What led to this expansion on a YOY basis for you? And 22%, is that maintainable for FY23?
Yeah, so we had very strong growth, as you said, really on the heels of pricing actions. Of course, raw materials have increased on a year-over-year basis, and we've been able to price into that inflationary market, really focusing on our high-value, high-margin products. And as Jay just mentioned, really working to time our product sales into the channel and into growers' hands, close to when they need them. And so we did see a bit of a shift in volume that we'll see play out in Q3 for us. But our margins, we expect to be strong throughout the year. And so this was a very nice growth from a margin perspective. And we would expect to see margins continue to be strong through the year.
Okay, that is good to know. So, Mr. Shroff, in that case, I wanted to speak to you in detail about some of the geographies, especially Europe. It was expected to be weak, 1%. Still, there is a 1% growth for you here. What is the outlook generally for your company, for the agrochemical players here in this case? Are you seeing any improvement in that particular market? What is it when it comes to competition? Or Europe plus one theme is something which is benefiting players like yourself?
I'll leave Mike to answer that in detail, but in general, let me just say that, the weather in Europe has been particularly dry this year. In spite of the fact that commodity prices are strong and farmers generally tend to use more products. But this was probably the driest summer in 500 years in Europe. So, this has caused a lot of challenges for the farmers. And but even in spite of that, I believe that our team is doing phenomenally well. But I'll let Mike answer that.
Yeah, generally our portfolio performed very well in Europe. If you look at it in euro terms, we're up about 15% on the quarter. Obviously, with the euro devaluation in INR, we're up 1%. And as Jay said, based on the impacts of climate change and the challenges that farmers experienced across Europe this year, our portfolio and our teams performed very well.
Okay, so going by whatever you told me that, okay, of course, Europe had that impact of extreme weather conditions. There was euro depreciation as well. Generally, what is the outlook in terms of volumes once this stocking issues go away, once you see second half changing versus the first half? Of course, it was a strong performance then as well. But what is generally the volume outlook for the second half, Mr. Shroff?
No, I mean, we continue to forecast 12 to 15% growth for the year. We feel quite comfortable that, the farmers are going to continue to invest in better technologies, sustainable technologies. Our whole portfolio in all these sectors is well positioned to benefit from all the climate-related impact, and also the strong demand for food, and generally the impact of having globally a very erratic weather system in the last year. So we believe that food prices will be strong, and UPL will continue to lead growth across everywhere.
All right. Well, that's the management of UPL sounding rather optimistic about times from here on, and they've stuck to their guidance, good growth or margins, as well as guiding for $650 million of debt reduction for the rest of this year. Well, we'll slip into a short break. You come back. We'll continue our focus on markets and stocks that are moving around.